Welcome back to another episode of Rich Dad StockCast. I'm your host, Denney, and today we're diving into one of the most exciting and dangerous times for investors, earnings season. Now, every few months, companies report their earnings, markets go crazy, stock prices jump, crash overnight, and a lot of people think that they can play earnings like lottery, but here's the truth. The rich don't gamble during earnings. They position themselves strategically. Now, joining me today is Rich Dad expert Andy Tanner. Andy is the master at showing everyday investors how to separate the gamblers from the pros, to how to actually invest smarter during earnings season. And before we jump in, don't forget to grab your free financial resources at stockcastbonus.com to help you navigate earnings seasons like a pro. Andy, welcome back to the show.
Del, this is going to be a great conversation. Can't wait to dive into this one. Probably say some things that people disagree with, so this will be great.
I'm excited to poke the tiger, but before I poke the tiger here, tell us about stockcastbonus.com. What do our listeners get when they go there?
Well, I just say go there now. It's a free resource, so that makes it a no-brainer. So go to StockCast Bonus. Pause this video if you have to go do it. There are 6 numbers that change your life. Learn what those are. Right now, we've got an ebook that's free that is a bonus for you for listening. And go ahead and download that and read it. And what's happening when you read that is you'll look at that and you'll say, that is my quantum leap towards my goals. If I learn those 6 and I do what is outlined in that ebook, your financial life will change. It's that simple. So the question is simply this: would you like to have your life change today financially for the better? If so, stockcastbonus.com.
There we go. All right. So let's talk about earnings season. What is earnings season for the beginner investor? They hear earnings season. What is that? When does it happen?
Well, generally, public companies in the United States, my home country, and around the world, depending on how their version of the SEC works. But because investors, want to know how their companies are doing, there's something called a 10Q, a quarterly report, and they report their earnings. They tell the world how they're doing. It's only fair that, investors, if they want to put money in a company, they ought to see what it's earning. And I think earnings season gets it backwards. There is an obsession. The focus should not be on the price of the stock. The focus should be on the value of the company, the work that the company does, and the money that earns. So I often use a object lesson called a cash flow jack in the box. I've got one on my shelf right there. See my little cash flow jack in the box. And that jack in the box has 3 parts to it. So let's talk about those 3 parts so you can understand earnings if it's in context of the 3 parts. Excuse me. The first thing is on that jack in the box right there, it's got a handle, and that's the work that's done. So every asset that cash flows will do work. Every asset that cash flows, you can find the work that's done and the value that it brings to a human being's life. So, for example, real estate, you're providing housing. There's value for a human being. There's shelter. There's a benefit that a human being gets for the money and rent that they pay. And so there's work to be done there. There's maintenance. The roof is replaced once in a while. The grounds are kept well. If the refrigerator breaks, it's repaired. There's maintenance mostly in real estate, is maintenance and management costs. But those efforts, that work that's done, produces value. So the biggest thing you start with any asset is, what is the quality of work that is going to be done, and is it competitive? Is it something people want? Because without that, there'll be no cash flow. Cash flow moves. So money has to flow from your customer's pocket into yours. There has to be that magnet that sucks money towards you. Well, the only way that happens is if you give more than you receive. That's the only way that happens. No one will part with their cash if it's just even Steven. there has to be a reason for them to let go of that. So they have to feel they're getting more, right? They have to get more than they pay. There's times where it doesn't matter how much money I have. There's times where I'll look at something, I'll say, I'm not paying that. I remember I was at Universal Studios in Florida, and I saw a cookie. And I went over to, I said, hey, that looks pretty good. Let's get that cookie. And they said it's $10.50 or something for a cookie. I said, you know what? That's not worth it to me. I mean, I had $10. I mean, I could afford it, but there's no way. I felt they were getting the better part of that deal, right? $10 for a cookie. So I've got plenty of spare food storage already. I don't need that cookie. So it's kind of like that. You have to have value. Okay. Now, if you have money left over after all this work that you're doing, you have your employees, your expenses, your raw materials. If there's money left over, that's a big deal because that proves something. That proves something really big. It proves that you are providing value efficiently enough that there's profit left over. And that's magic, right? You have profit, earnings, bottom line, cash flow, whatever you want to call it. The third part of that box, you have the work, you have the earnings, and then you have the price. And ideally, you would evaluate the price one time, once. In fact, not ideally, you should only evaluate one time. You pay the price one time. That's it. We're not buying low and hoping the price goes up. Our goal, to use our our goose analogy, our goal is golden eggs. No one looks at a goose that lays golden eggs and says, I think I'll buy this goose this week because next week I think it'll go up. And I'm going to buy this goose today. And I'm going to bet that it lays 2 eggs next week instead of 1. Because if I have a 2-egg golden goose, the price of the goose will go up and I'll sell it. That's how people approach earnings, and it's insane. And people will look at a stock and they'll say, I think the earnings will probably go up. So I'll buy the stock. It'll show great earnings and the stock price will go up and I'll sell. That is not business owner. That's not how it works. It's backwards. We don't look at earnings hoping it affects the price. We actually pay the price to enjoy earnings perpetually. And I would not sell a stock because the price went down. I would not have a goose that is producing golden eggs, and all of a sudden the price of the goose goes down because of emotion or herd mentality or, whatever it is. It's not in vogue to have geese, I guess. But I'm just going to look at the amount of eggs it produces. That's going to make my decision. If it looks like it's getting old and sick and it's not going to produce eggs anymore, well, I'm going to sell it no matter what the price is, right? Price should not be my focus. Earnings and work should be. So of the 3 parts to that cash flow jack in the box, I'm focused on the quality of work. That's your best risk management in the world begins with the quality of work a company does. There's this idea that the necessities of life are food, clothing, and shelter. That's total crap. That's total crap. Oh, so you don't need electricity? You don't need energy? You just need food, clothing, shelter. You don't need energy. Oh, you don't need the communication. You don't need that iPhone. You don't need email. You don't need internet. You don't need energy. Oh, you don't need medicine. You don't need medicine. So this food, clothing, shelter is bullcrap. People need all this type of. Oh, you don't need any entertainment anymore. Well, that's not a necessity. Yeah, it is. And so it is the work that is going to ensure that your asset has longevity more than anything else. The quality of business that it is and its ability to serve people is your best risk management tool out of the gate. If it earns money, that is proof of efficiency. And then you look at the price last. So earnings season comes out and I just don't care about what it does to prices. I care about what it says about a company. And you got to keep that in order. And here's the other thing. Risk, Robert taught me this, and I was pissed when he taught it to me because I thought I should have known this. I shouldn't have had to have him spell it out for me because it was obvious. But he did. He had to spell it out for me. I was like, oh, he's right. Risk is related to control. So when I have a lot of control, I have less risk. So if I'm going to invest based on guessing earnings, then my goodness, that's not in my control, and my risk goes through the roof. So I can't control whether they meet earnings, fail to meet earnings, raise guidance, lower guidance. I make control on that. So I'm not going to invest and make decisions based on predicting. That's crazy.
So
That's nutty to me.
what's the difference between speculation and being an investor? Like, kind of going along with that idea.
Yeah. Well, you're always going to speculate on some aspect, but I think the biggest thing when you talk about speculation versus investing is you're focusing on price or not. When I'm a rental, if I have rentals, I'm speculating that the rent will be consistent. I'm speculating that the person I'm doing the background check that doesn't have anything that's not in the background check, right? There's always unknowns. You don't get to say zero unknowns. There's always going to be some risk. But you have a spec home, which is a speculation home, is where you're speculating on price movement. So again, as soon as you move your focus from the work that's being done and the earnings being produced, and you start focusing on price movement, now you're a speculator. So speculators try to predict price trends and movements, which don't always equate. We hope they come in line with fundamentals, with the fundamental things, the work and the earnings. But boy, I would focus much more on the quality of company in the earnings than the price earnings. That's just how I would operate on that. Price is not that important.
There we go. Well, let's do this. Let's go to break. We've just uncovered why most people lose money during earnings and why the rich use it differently. After the break, Andy and I are going to show you how to actually invest smarter during earnings season without gambling, guessing, or getting caught in the hype. And remember, go to stockcastbonus.com to grab your free investing resources so you can start applying what we're teaching today. Stick around. We'll be right back.
So far, it's been great. I needed a source where I could really enrich my education through stocks. I didn't really have an avenue for it, and it's helped me a lot. The simplicity has really gotten me on the track to where I enjoy the learning as well as it's really solidifying in my mind. And like, they're not just trying to sell you something, they really care about the people that are in the course, and they really do care about you and your personal goals, and what you want to do is to help you and your family and whatever your goals are in life through that. So it's really been great.
All right, Andy, let's get tactical. When you're looking at a company during earnings season, what do you personally focus on? Like, what numbers or trends matter the most to you?
I would say, well, you want to get wonky? I mean, I can hear Robert already yelling at me saying, Andy, stay big picture, and don't use jargon, and, be a better teacher. But we'll risk that. And let's talk about what we call, let's define some jargon. There's something called implied volatility. Now, what does that mean? Well, implied means it's implicated. It's not explicit, it's implicit, right? It's implicated. It's not something we've seen, it's something we think we will see. It's implied. It's not expressly stated or demonstrated, it's implied. And volatility just means stuff is moving and wiggling a lot. It's volatile. It's not stable, it's volatile. Well, we know that there are lots of people that are concerned about price every day. You go to CNBC, price. What's up? What's down? What are the biggest movers? What are the biggest winners? What are the biggest losers? Price. They don't focus on ownership. So as a result, when earnings comes out, there's movement in stocks generally. Someone says, oh, we beat earnings. Well, oh, let's buy this stock. It's really good. Oh, we failed in earnings. Oh, let's sell our stock, right? It didn't do well. So earnings implies volatility. In other words, there's an implication that on the earnings date, when they announce those earnings, that the stock would move more than it would move in a regular day. What that means is the price of the options will increase. It means that if the investors that want to protect themselves or speculate on that there's more premium there. You're either going to pay or receive more premium for the sale of an option. So you'll see the prices of options go up as you get closer to an earnings date. And we call this implied volatility rise, and then it crushes. It goes straight down. If you want to see examples of this, a good example of a stock that has a great volatility pattern is FedEx, for example. And if you bring up your FedEx price chart, and then underneath in your software say, give me an implied volatility chart, underneath that, you will see a rise in the implied volatility, and then it hit earnings and it drops. Rise and then drop, rise and then drop. And so that's how that works. Well, for me, the reason I care about that is I can make money on that. And I can make money on that in a couple of ways. Generally, I'll sell the option. I won't buy it because if I know there's going to be a volatility crush, that means the option prices will fall after the earnings date. So we do this in our Mentor Club all the time. We have a weekly club that people can join and watch us trade. And one of the trades we'll often do is what we call a volatility crush trade, where we'll exploit this implied volatility going into earnings, and then it drops. Another stock that has a great profile for this is Meta, Facebook. Meta will do this. FedEx will do this. There's others, and some are more pronounced than others. But yeah, so around earnings, if you want to know the metrics, I will pay attention to implied volatility, and I'll tend not to buy options. Even for protection, I'll want to get that done way before. If I'm really worried about an earnings, I've heard a whisper, I'll want to buy my puts and buy my protection way before that, because the closer it gets that date, the more it's likely to wiggle, the more expensive that insurance would be. But as an investor, I really come back to the quality of work that's being done. I'll give you an example. One of the stocks that I own that I really love is Dow Chemical, and they're having a hard time. There's tariff stuff affecting them, and the demand, global demand, is down for a lot of their products. Well, that's just a business cycle, right? That's a business cycle. They'll pause. I was listening to the earnings call. They'll pause some of their operations when it gets rough like this. Okay, that's fine. That'll lower expense. And we're just going to lower expense as demand drops. But demand will not be eliminated. And when I look at, the things that are in this room, the carpet, the paint, that's all coming from Dow or DuPont. And while there'll be fluctuations in demand, there'll never be zero demand. And those guys have size and competitive advantages. Right now, their dividend is threatened. They paid a dividend every month since 1912, and it's threatened because their payout ratio is way too high. But I still feel confident in that for the time being, because you can't, as an investor, panic when you see a demand for something drop that's cyclical instead of permanent. Now if they were selling 8-track tapes, or they were selling, if they were a video store where you'd go and browse VHS tapes or DVDs, and that's the demand for that stuff is gone permanently. But the demand for carpet, and the demand for paint, and the demand for the silicone and the things they make, that's cyclical. We're still going to need those things. So again, around earnings, I'm not so much worried about their earnings as I'm worried about the quality of work that they do. And as an investor, you got to have a good temperament. Besides that stock, I every time you were mentioned, you look at that as a golden goose, as a goose that lays golden eggs. It's going to lay eggs. Now it's going to lay more some seasons and less others, but it's a good goose. And I've taken enough eggs out of that goose that the stock is paid for itself. So what the hell do I care? What do I care what the price of that stock is when it's completely paid for? It's paid for itself time and again. So I don't have any money in that asset. It's no different than if my Uncle Larry would have given it to me and said, here's a bunch of shares of this, no risk. I had no money in that stock. If Uncle Larry gives it to me, well, I have no money in the stock if the goose has laid eggs that's paid for itself. So what do I care? So I'm not going to freak out over earnings if it's cyclical. Now, if it's Blockbuster Video and I see their earnings waning, and I say, okay, why are their earnings waning? It's because no one wants their stuff. And that's not a cyclical problem of demand. That's not a business cycle. That's not a recession cycle. But if you sell all your stocks during a recession, I don't think that's smart. I think you just, why do that? That's silly. own the business, take a reduction in your dividend if that even happens. You'll be fine.
There we go. Now, I want to talk about
I
cash flow.
know. I thought you were going to talk about golden goose.
Well, actually, I'm thinking about those eggs that
I
you keep on talking
saw
about.
when I said golden goose, your face was like, and I knew it was going to come.
We can't do a podcast without talking about the golden goose, and
It is the perfect fable.
It really is. And in fact, for our longtime listeners, I think we should play a game. Anytime Andy says golden goose, throw the goose, or excuse me, throw the egg emoji in the comments.
Put a golden egg in the emoji. I don't know how to do that. Maybe someone can figure out how to put a golden egg in every time I say that. That'd be fun. That'd be fun.
There we go. It's like when you watch those Marvel movies, there's the hidden Easter eggs. Well, we're throwing golden goose eggs into our podcast.
Didn't know that. I'll have to start looking. Didn't know that.
There we go. Well, let's talk about cash flow investing, right? How can investors use earnings season to find better cash flowing assets like dividend stocks or covered calls? How can we use this earnings season to find better cash flowing investments?
I wouldn't. I wouldn't let future earnings dictate what I was going to do. I'd look at the past. If I saw it now, if I look backwards, I can get a lot more information because it's stuff that I know rather than speculation about forwards. So if I see a stock, like you could look at a company like Elon Musk, like Tesla. Their PE was like 300 and something. You're paying $300 for $1 of earnings, and they were losing, and for some time it was zero. They had no earnings. They were losing money. But you saw a trend of they were losing less. And you also know they were investing heavily in growth. So they had a choice. They could have made their balance sheet earnings. They could have been profitable, but they would have had to eliminate their investments for R&D and growth and things like that. So you saw a trend not of earning money, but of losing less money until they finally got profitable. So I would rather look at a trend of earnings in the past rather than try and guess about it in the future, because I don't know what the future is. I don't have a crystal ball on earnings. So when you see growth, if you go back to The Intelligent Investor by Benjamin Graham, Warren Buffett's mentor, he has a sample. It's not the one he used. Most people miss that. But he has a sample value formula where value equals a bunch of stuff. And he has the interest rate in there and a bunch of different things, the formula. The reason he has the interest rate in there is he says, for it to be valuable, you should beat a bond. Why would you put your money in a stock if it can't beat a bond? So he looks at, a general interest rate as a floor. You got to beat that. And then he has earnings that the company should earn. Then he has growth. And those are the three basic components in that formula, that it should have a certain amount of growth and a certain amount of earnings. This should beat an interest rate handily. And if it does those things, then there's value in there. So how do you see growth in the future? You look at the quality of work. The quality of work is the better predictor of whether that company will increase earnings. You look at companies that are, I think the value of the work in every company is going to be better. I think the opportunity over the next 10 years to own stocks, if you're not in stocks for the next 10 years, you're nuts, because AI is going to make every company produce more. The work, that handle, gets better with AI. It just does for every company, not just technology companies. Every company will use this. How people make sandwiches will change. How people make tires will change. How people pump oil will change. AI will make us so much smarter and efficient in how we do things. So if you want to look at predicting earnings, look at the quality of work and where that's headed. And if the quality of work is necessary, popular, and in high demand, the earnings will follow. But if you want to look at earnings as a metric, look in the past. If you want to see the future, look at the work. If you want to see the trend in earnings, look at the past. And I just have to say it again. Get off the price thing. Get off the buy low, sell high. I do not wake up in the morning and check my Zillow reports on the properties I own to see if their price has moved. And oh my gosh, the price of this house is falling. We better sell it. Oh my gosh, the price of this house has gone up. We better sell it. I would never make my decision to buy or sell an asset based on price movement. Never. You could never look at that in isolation. You would always have to look at the price and then something else. So in fundamental analysis, which is, to define that jargon, analyze means to look at things carefully. Fundamentals means important stuff, right? The most important stuff. If you do a fundamental analysis on a human being, you're going to look carefully at blood pressure, cholesterol, A1C, stuff like that, right? BMI. Well, if you're going to look at a business, you're going to look at earnings and growth. And so you have price to book value, price to sales, price to earnings. Price is never isolated. Price is only meaningful when you look at how it relates to that business. So earnings, schmurnings. Is there opportunity for option selling? Yes. Is there opportunity for volatility crushes? Yes. Can you make money on volatility crushes if you know how Greeks work, if you know how, theta and mostly vega is the important one, but you're going to have a theta and a vega component and a delta component to those trades, and they're not for beginners, they're for intermediates, not for experts, they're for intermediates. But yeah, earnings, does it provide opportunity? In the options market, I'd say yes. In the stock market, I'd say less so, because the volatility crush is predictable, but whether they beat earnings, meet earnings, or fail to beat earnings is not predictable. So we can predict a volatility crush most of the time, because we can predict an unknown becoming a known. That will happen. The unknown report will become a known report. That can be predicted, but the direction of the stock cannot be.
Now, one last thing. First off, Andy, this has been an incredible conversation. But if someone was brand new to thinking about earnings season the way Rich do, what's one simple action step they should take after listening to this episode?
Go to stockcastbonus.com and start learning more important things that first come first. We don't do heart surgery until we learn basic first aid. Right. If you want to try to do a volatility crush on earnings, and you've never traded an option yet, there are other things to do before you try to do an intermediate trade. So, learn and get committed and spend time every day learning new things, getting mentors. Join our Mentor Club if you want to watch how this works. The Mentor Club is I love to pitch the Mentor Club to people, because what it is you get to watch what we do every week. And there is no better learning that can be done than just the real thing. We used to have this thing that we'd reference. I'll give credit to Edgar Dale, the late Edgar Dale. He had this thing called the cone of learning.
Oh, yeah.
So go look it up. And it says the best way to learn something is doing the real thing. And the next best thing is to, simulate doing the real thing. So you could get a paper trade account, and you could copy what we do at the Cashflow Academy every single week. Every week, you could literally take the trades we have and just start copying them in your paper trade account, risk-free, and learn what we're doing. If you want to learn Spanish, move to Spain and start speaking Spanish. You'll learn Spanish better by living in Spain for a year and speaking it than going to a Spanish class. So that's why we do our Mentor Club, is we learn by doing the real thing. And there's just nothing better than the real thing, because you can't fake the real thing. Those stocks move up and down, the earnings either come, the premiums either work out or they don't. So your first step would be to go to stockcastbonus.com and see if those 6 numbers make sense to you. See if the process makes sense to you. If it does, go join our Mentor Club and do that for a year. Not very many guarantees I'll offer in stocks and in life, but I will tell you, if a guy does 52 sessions with us, a year later, they're going to know a hell of a lot more than they knew before they started. And that's a freaking guarantee for sure. They're going to learn a lot. So that's how you get started. You hang out with people that know how to do it, that have done it for 20, 30 years, to where it doesn't even get our heart rate up. We just do it and start doing it with us. That's the way to do it. Do it.
There we go.
We'll take you by the hand, walk you through it.
That's fantastic. Well, that wraps up today's episode of Rich Dad StockCast. Remember, the rich don't gamble during earnings season. They invest smarter. They look at fundamentals, cash flow, systems, not hype, not headlines, definitely not emotions.
Not guessing.
Not guessing for sure. And a huge thank you to Andy Tanner for breaking this down for us.
Thanks, Del.
If you're absolutely welcome. If you're serious about leveling up your investing skills, go to stockcastbonus.com right now and grab your free financial educational tools. And if you found that today's episode valuable, like, subscribe, leave a comment, share this with someone that needs to stop gambling and start investing the right way. And thank you for tuning in to Rich Dad StockCast. I'm Del Denney. Stay smart, stay invested, and take control of your financial future.
Thanks, Del.
This podcast is a presentation of Rich Dad Media Network.